Physical gold is currently trading at historic levels, with valuations hovering near a staggering $4,380 per ounce. This high price reflects gold's role as a financial bunker. Investors traditionally move their capital into precious metals during periods of global anxiety to shield their wealth from market volatility. That stability broke at exactly 8:30 a.m. Eastern Time today. On digital dashboards across Wall Street, gold prices took a sharp turn downward, erasing the morning's gains in a matter of minutes. Usually, a move this fast follows a major shock. But this morning, there was no surprise interest rate hike, no geopolitical crisis, and no broader collapse in the stock market. The trigger was far more localized, a routine monthly survey filled out by factory managers in New York State. The mystery lies in the scale of the reaction, how a regional manufacturing report managed to shift the global valuation of the world's primary safe haven asset. Each month, a New York Fed releases the Empire State Manufacturing Survey. Analysts treat it as a leading indicator, using this regional data to gauge the health of the broader American economy. Heading into the morning, consensus was pessimistic, forecasting a sluggish score of 10.2. But the actual data released at 8:30 a.m. told a different story, surging upward to hit 20.6. Zooming out over 4 years, this reading is the highest in nearly half a decade. Inside the report, the number showed physical growth. New orders for goods and the actual shipment of products both saw solid, measurable gains. There was a human component to this surge as well. Regional firms reported hiring more staff and increasing the average number of hours their employees worked each week. The sudden combination of rising orders and increased hiring upended the narrative that the economy was cooling down. This sudden evidence of economic strength creates a direct conflict for gold. Traditionally, the price of safe haven commodities moves in the opposite direction of the broader economy. When factories are this active and the 6-month outlook is optimistic, the psychological need for a financial bunker begins to fade. Traders moved quickly to pull their capital out of gold, looking to put that money back into active growth investments. On the trading floors, this data translated into a wave of sell orders. The global market reacted the moment New York figures were made public. The immediate sell-off functioned as a mechanical reaction to the positive economic news, a sign that a booming factory floor is often the natural enemy of a high gold price. Following that initial shock, spot gold has stabilized slightly below $4,380 per ounce as the market processes the full report. While the headline number was strong, the survey also identified growing pains, specifically a drop in supply availability and significantly longer delivery times for goods. At the same time, the cost of raw materials, the prices paid by these factories, is beginning to pick up. This suggests that the pressure of inflation hasn't been entirely resolved. These inflationary concerns are likely what kept gold from a total collapse, providing enough support to keep the asset near its historic highs, despite the strong manufacturing data. Today's volatility highlights how closely global commodity prices can track the day-to-day health of regional industry. It serves as a reminder to watch local factory floors just as closely as the gold charts themselves.